is the first of two concluding sessions in the course that integrate aspects of the investment decision with aspects of the financing decision. We cover the purpose of the financial plan, the contents of the financial plan, and then steps in financial plan development. These steps begin with an assessment of the financial position of the firm, the definition of debt policy, determination of the asset requirements going forward, evaluation of financing options, and finally, integration of the information that's developed in the financial plan into the management control structure of the firm. The financial plan is a document that serves multiple purposes. Most important, it serves to assure that the strategic plan of the firm can be achieved. The principal barrier to a successful strategy is the ability to finance it. That is, the most creative ideas can't be achieved without securing the financing. Because of the importance of the financial plan to achieving the organization's strategy, financial planning is often called strategic financial planning. A second purpose of the financial plan is to analyze the interactions of the financing and investment choices open to the firm. How does the selection of one asset mix influence the types and financing instruments used? For example, some assets and related business opportunities might involve more business risk than others. And as we have learned, in this situation the firm might be more likely to use debt financing. The principal document of the financial plan is actually a projection into the future. It is a pro forma balance sheet that summarizes the consequences of decisions embedded in the strategic plan. The financial plan then forms the basis for deciding which investment and financing alternatives available to the firm ought to be undertaken. As we shall see, an output of the financial planning process is information that informs determination of the required return on equity, which of course is an important component of the weighted average cost of capital, or the discount rate. Finally, the financial plan provides some benchmarks against which to measure future performance. As just noted, it provides a required return on equity that must be achieved. It also provides a target balance sheet or future financial picture of the firm that the firm needs to actualize to achieve the goals of its strategic plan. The typical financial plan has at least three main pieces. It has pro forma financial statements, including a pro forma balance sheet, a pro forma income statement, and a pro forma cash statement. It contains a capital expenditure plan that is required by the business strategy of the firm, and the business strategy will be described in the financial plan. And it has the planned or necessary financing to support the capital expenditure and business strategy. In the remainder of this session, we'll describe one process that can be used in financial plan development. Firms obviously use a variety of methods to create their financial plans. The method described here is just one approach, but it contains the steps and processes common to the methods applied by many firms. The steps are: assessment of the financial position of the firm currently, definition of optimal debt policy, determination of asset requirements going forward that are necessary to support the business strategy of the firm. Evaluation of options for financing the asset requirements. And finally, integration of the information developed in the financial plan into the management control structure of the firm. The first step is to assess the firm's present financial position. This step is necessary in order to develop an understanding of how the firm has performed in the past, and therefore what it might or might not be able to achieve in the future. Financial position assessment is often done by calculating some revealing financial ratios. Financial ratios are often classified into about 5 categories. Here is a typical categorization: capital structure ratios, profitability ratios, ratios describing efficiency or productivity, liquidity ratios, and market value ratios. Likely you have encountered financial ratios in other courses. The text also has a good presentation of them. So here we'll focus on those ratios in each of these categories that are most useful for financial planning. That list begins with the components of DuPont analysis. DuPont analysis is also called long-run viability analysis. This analysis focuses on the return on equity of the firm as the key to financial viability. The method is to disaggregate return on equity into important components, which can themselves be studied to understand more fully the reasons for a particular level of financial performance and the ways to improve financial performance. Here is the DuPont analysis structure. Return on equity is presented as the product of some important financial ratios. The leverage ratio, defined as the ratio of assets over equity. The asset turnover ratio, defined as the ratio of sales or revenues divided by assets. The profit margin, defined as the ratio of earnings before income and taxes minus taxes divided by sales or revenue. And debt burden, which is defined as the ratio of earnings before interest and taxes minus taxes and minus interest divided by earnings before interest and tax. First, let's verify that return on equity is indeed the product of these ratios. We can do that by crossing out some terms in the return on equity equation. We can cross out assets in the numerator of the leverage ratio and in the denominator of the asset turnover ratio. We can cross out sales in the numerator of the asset turnover ratio and the denominator of the profit margin. And we can cross out earnings before interest and taxes minus taxes in the profit margin and in the denominator of the debt burden. What we're left with is earnings before interest and taxes minus taxes and minus interest in the numerator and equity in the denominator. So what we have is essentially in the numerator net income after the firm has paid taxes and interest divided by equity. And that's just the definition of return on equity. So we can see that the return on equity equation in DuPont analysis is indeed a disaggregation of the component pieces of return on equity. And the disaggregation allows us to do some interesting analyses about the reasons for a particular return on equity and the ways in which return on equity might be improved in the future. Let's also note that two component ratios of the DuPont analysis themselves comprise return on assets. That is, asset turnover times profit margin maps out return on asset. You can see that by looking up here to the component ratios of return on assets, these two, and you can see that if we just crossed out the sales in the numerator and sales in the denominator here, what we're left with is earnings before interest and taxes minus taxes divided by assets. Or we're left with earnings before interest and after taxes, if you will, so after taxes have been paid, divided by assets, or the return that's paid to both the debt and equity suppliers divided by assets, and that's exactly what we've been looking at as return on assets in previous parts of the course. To see how to use DuPont analysis as a way to understand the performance of the firm, let's review the meaning of each of the component ratios briefly. The focal ratio in DuPont analysis is return on equity. Return on equity is defined as net income divided by equity, or earnings before interest and taxes after the interest and tax payments have been made divided by equity. It's classified as a profitability ratio. One interpretation of return on equity is that it's the rate of growth in equity over time. Return on equity is the focus of the DuPont analysis because return on equity is the key to financial and therefore operational and strategic success. That is, if the firm can grow equity, then the firm qualifies to borrow or to raise debt funds on good terms and at good interest rates. And if the firm can grow equity and raise debt funds on good terms, then it's able to acquire the assets necessary to support its business strategy. And if it can acquire the necessary assets, it can provide the services consistent with its mission and strategic plan. One component ratio of the DuPont analysis is the leverage ratio. The leverage ratio is defined as assets over equity. It's classified as a capital structure ratio, and it shows the benefit of using financial leverage in multiplying a particular operating result. Note that the leverage ratio is the inverse of the equity financing ratio, which is defined as equity over assets. This is a ratio we've encountered a lot in previous parts of the course. Recall that the equity financing ratio is the percent of assets financed by equity. The equity financing ratio is the complement of the debt financing ratio, which is defined as debt over assets. And you recall that the equity financing ratio and the debt financing ratio are important determinants of the firm's access to debt. Specifically, firms with higher equity financing ratios and therefore lower debt financing ratios typically have greater access to debt on good terms. A second component ratio of the DuPont analysis is asset turnover. Total asset turnover is defined as sales or revenue divided by assets. It's classified as an efficiency or productivity ratio, and it indicates the productivity of assets in generating revenue. And specifically, the asset turnover ratio gives us the number of dollars of revenue produced per dollar of assets employed. Now, if we think of revenue as the essential output of the firm and assets as one type of input, production input for the firm, we can see that the asset turnover ratio is a ratio of outputs per inputs. And in that sense, it is a productivity ratio. The kind of productivity ratios you looked at in your economics courses. Recall that a productivity ratio typically relates a measure of output to a measure of input. An important complementary ratio to total asset turnover is age of assets, which is calculated by taking accumulated depreciation from the balance sheet and dividing by depreciation expense on the income statement. Because depreciation expense indicates the amount of depreciation recognized in 1 year, and because accumulated depreciation indicates the aggregate amount of depreciation expense that's been accumulated over the life of the firm, if we divide the 1-year depreciation expense into the accumulated depreciation, what we're going to get is an estimate of the number of years that the firm has had its assets, or the number of years that the firm has been depreciating its assets off. And that is the calculation for the age of the assets. Firms with older assets will tend to have higher total asset turnovers because old assets are largely depreciated down. As assets are depreciated, the denominator of total asset turnover falls, thereby raising the total asset turnover calculation. So firms with old assets ought to show better total asset turnover ratios. In contrast, firms with newer assets will typically show lower total asset turnovers. The third component ratio of the DuPont analysis is profit margin. Profit margin is defined as net income divided by sales or revenue. There are actually a couple of specific definitions of profit margin. One is to take the ratio of earnings before interest and taxes minus tax payments divided by sales or revenue. That version of profit margin reflects the profit rate to all investors. A second version is to take earnings before interest and taxes and to subtract off both interest payments and tax payments and to divide that by sales or revenue. And this version of profit margin focuses on the profit rates to equity investors only. Profit margin is obviously categorized as a profitability ratio, and it specifically indicates the percentage of revenues that are converted to profits. The last component ratio of the DuPont analysis is debt burden. Debt burden is defined as the ratio of earnings before interest and taxes minus taxes and interest to earnings before interest and taxes minus taxes. It's classified as a capital structure ratio, and it shows the extent to which profits have been reduced by debt service payments, or specifically by interest expense. A complementary ratio to debt burden is times interest earned, which is measured as the ratio of earnings before interest, taxes, depreciation, and amortization, or our old friend EBITDA, to interest expense. Times interest earned indicates the cash flow available to cover the interest payment. The numerator of times interest earned is the cash flow generated by the firm's operations that's available to make the interest payment. And obviously the denominator is the interest payment itself. So the ratio here is the number of times the firm generates cash sufficient to cover the interest expense. In general, firms with high times interest earned are viewed as having additional debt capacity. In this sense, times interest earned is a ratio complementary with the debt financing and equity financing ratios. Firms with low debt financing ratios, and therefore high equity financing ratios, and with high times interest earned, have particularly high additional debt capacity. The financial markets view such firms as having good credit and therefore as meriting access to debt on good terms and at low rates. As noted earlier, an important ratio composed of two of the DuPont analysis component ratios is return on assets. Return on assets is defined as the ratio of earnings before interest and taxes minus taxes to assets. It's classified as a profitability measure, and it indicates the return on investment that's available to all investors, or that's paid to all investors, including equity investors and debt investors. The ratios described up to now are typically calculated from information on the financial statements. Hence, the ratios are book value ratios. Firms and investors also need information reflecting and describing market value. So on this page we have a few of the most important market value ratios. The most important market value ratio is stock price, which you can find in the financial pages or on the internet, and which is determined fundamentally by the ratio of earnings per share or dividends divided by the discount rate minus the growth rate. The second market value ratio is the market to book ratio. We've discussed this ratio before in the course. It's defined as the ratio of stock price to book equity per share. And it indicates the extent to which the book value of the firm understates the market value, or the extent to which the firm value has increased since the stock sales to the owners of the firm. The third market value ratio is the price earnings ratio, which is defined as stock price divided by earnings per share. The PE ratio is the conceptual inverse of the market capitalization rate, or the required return on equity. A firm with a high PE ratio might be a firm that the market has capitalized at a relatively low required rate of return on equity. It also might be a firm where the market expects a high rate of growth. Here are a few other ratios that are important to the financial planning process, even though they are not components of the DuPont analysis. First is the current ratio, which is defined as current assets divided by current liabilities, where current assets are assets that can be converted to cash within a year or that are cash already. Current liabilities are debts that have to be paid off within a year. So the current ratio indicates the dollars in current assets available per dollar of current liabilities. The current ratio is classified as a liquidity ratio. In fact, it's the most commonly evaluated or considered liquidity ratio. And it's an indicator of the short-term solvency of the firm. Hence, this ratio focuses on the short-term prospects of the organization, whereas the DuPont analysis component ratios, at least taken as a whole, focus on the long-term viability of the firm. Finally, we have the payout ratio, defined as the ratio of dividends to earnings. It indicates the percent of net income that's paid out as dividends. A related ratio is the plowback ratio, which is the complement of the payout ratio, or which is defined as 1 minus the payout ratio. It indicates the percent of net income that is not paid out as dividends, but rather that is retained earnings and serves to build up the equity in the firm. A measure closely related to the plowback ratio is the equity growth from plowback, defined as earnings minus dividends divided by earnings. This ratio indicates the percentage of earnings that are used to grow equity. Let's use the example in the text of dynamic mattress to see how to perform a DuPont analysis. Here are the component ratios of the DuPont analysis already calculated. Let's go to our Excel file to see how these calculations were done. We're back to our financing Excel file, and we have 3 related worksheets. We have the dynamic mattress balance sheets, the dynamic mattress income statements, and the dynamic mattress ratios. So on this sheet, we show the summary balance sheet data for the firm. The income statement sheet shows the summary income statement data. And here are the calculated financial ratios for dynamic mattress. So let's calculate a few of these financial ratios. Let's start with an important capital structure ratio, the equity financing ratio. The calculated number is 0.61, indicating that 61% of the firm's assets are financed by equity. This calculated ratio is based on 2 numbers from the balance sheet. So let's scoot over to the balance sheet. The 2 numbers we need are shareholders' equity in the numerator and total assets in the denominator. So the ratio of equity to assets here is 0.61. Next, let's calculate the current ratio. The calculated number is 2.41. Let's see how that number was arrived at. You can see that the formula requires 2 numbers from the balance sheet again, B9 and B21. So let's scoot over to the balance sheet, and you can see that in B9 we have current assets of 325, and in B21 we have current liabilities of 135. The current ratio is defined as the ratio of current assets to current liabilities, and the calculated number is 2.41, which indicates that for Dynamic Mattress there are $2.41 in current assets for every $1 in current liabilities. Or it has assets that can be converted into cash within 1 year of $2.41 for every $1 in debts or liabilities that have to be paid off within 1 year. Now let's calculate an important efficiency ratio, the total asset turnover ratio, which, by the way, is also called the sales to assets ratio. The calculated number is 3.83. Recall that this ratio is defined as sales or revenue divided by assets, and it indicates the dollars in revenue produced for every dollar in assets that is held by the firm. So to calculate this ratio, we have to get a number from the income statement in the numerator and a number from the balance sheet in the denominator. So we need B4 from the income statement and B15 from the balance sheet. So let's scoot over to the income statement, where in cell B4 we have revenues of $2.2 billion. That's the top line of the income statement. Now let's go over to the balance sheet. And B15 has our total asset number of $575 million. So the ratio of revenue to assets is 3.83. The interpretation of a total asset turnover ratio of 3.83 is that the firm is able to generate $3.83 in revenue for every $1 in assets that it has invested. Now let's look at some important profitability ratios. Let's start with the focal ratio for DuPont analysis, which is return on equity. The calculated number here is 0.17. Recall that the definition of return on equity is net income over equity. So to get this 0.17 ratio, we have to go to the income statement and read net income, which is in cell B13, and then we have to go to the balance sheet and read equity, which is in cell B24. So here we are on the income statement, where net income is shown as $60 million. Here, net income is calculated as earnings before interest and taxes minus interest expense minus taxes, and there we have net income. Now let's look on the balance sheet and get equity, which we've seen is $350 million. So now we have the numbers we need to calculate return on equity, which comes to 0.17. So Dynamic Mattress earned a return on equity of 17% in 2009. One interpretation is that Dynamic Mattress was able to grow equity at a rate of 17% based on the book value of equity. Another interpretation is that the shareholders earned a book value return on equity of 17%. Now let's look at another important profitability ratio, profit margin. The calculated number is 3%. To calculate profit margin, we need three numbers from the income statement. We need the number in B9, the number in B12, and the number in B4. So let's scoot over to the income statement. For purposes of the DuPont analysis, profit margin is defined as earnings before interest and taxes minus taxes divided by revenues. The result is a 3% profit margin for dynamic mattress. Now let's look at one more profitability ratio, return on assets. The calculated number is 11%. Return on assets is defined as earnings before interest and taxes minus taxes divided by assets. We need to go to the income statement to get the earnings before interest and taxes and the tax amount, and we need to go to the balance sheet to get assets. Here on the income statement, we have our earnings before interest and taxes of $125 million minus our taxes of $60 million. And this difference is the numerator in the return on assets ratio. And the denominator is total assets of $575 million. So our calculated return on assets is 11%. One interpretation is that Dynamic Mattress is able to earn a return on its assets of 11% or a return on its invested capital, including debt and equity, of 11%. Now let's combine some of these ratios plus one more in the DuPont analysis. The DuPont analysis focuses on return on equity, which we calculated previously to be 17%. The analysis decomposes return on equity into some important components that can provide information on how the firm was able to achieve a particular return on equity and how the firm might be able to increase its return on equity by making improvements in its operations or financial structure. The first component ratio is the leverage ratio. Recall that the leverage ratio is the inverse of the equity financing ratio. So what we do is to go up to our calculated equity financing ratio of 0.61 and invert that number, and we thereby arrive at a leverage ratio of 1.61. The second component ratio is asset turnover, which we calculated earlier to be 3.83. The third component ratio is profit margin, which we just calculated to be 3%. The final component ratio is debt burden, which we haven't calculated or defined previously. Debt burden indicates the extent to which interest expense reduces return on equity. I'll leave it to you to see how the debt burden is calculated. Now, if we multiply the four components of the DuPont analysis together, and you can see how that's done here at the bottom, you can see the formula. We'll get our return on equity calculated of 17%. And that calculation matches the return on equity that we calculated directly from data on the income statement and the balance sheet. As noted a bit earlier, the utility of the DuPont analysis is that it helps us to understand how Dynamic Mattress achieved a return on equity of 17% in 2009. What the analysis tells us is first that Dynamic Mattress used a leverage multiplier of 1.61, which comes from its equity financing ratio of 0.61, to boost an operating result and achieve a particular return on equity. This relatively low leverage multiplier is associated with or due to the high equity financing ratio that Dynamic Mattress employs. A second partial explanation for their resultant return on equity is that they achieved an asset turnover ratio of 3.83. Now, a 3.83 asset turnover ratio is a relatively high ratio. That is, Dynamic Mattress was able to generate a large volume of revenues and sales for the assets that it employs. Indeed, it's reasonable to conclude that perhaps the principal explanation for Dynamic Mattress's ability to grow equity at 17% is its very high efficiency of operations as represented by its asset turnover ratio of 3.83. A third component explanation for their overall resultant return on equity is that they achieved a profit margin of 3%. Now, a profit margin of 3% is not relatively high. In fact, it might be considered average to below average. It's reasonable to conclude that the relatively high return on equity was not due to a particularly strong profit margin. The final component explanation for their overall return on equity result is that Dynamic Mattress had a debt burden of 0.92. Now, a debt burden of 0.92 is really quite a minimal debt burden. You can think of the maximum value that the debt burden can take on as 1, and 1 would indicate that interest expense does not reduce return on equity at all. And a low debt burden is fully consistent with a relatively high equity financing ratio. So looking at these ratios overall, I would conclude that Dynamic Mattress did well in terms of its return on equity. The main reason for that high return on equity was the efficiency with which it used its assets to generate revenues. Dynamic Mattress did not use a lot of financial leverage or debt to boost its operating results and thereby increase return on equity. The very high level of efficiency with which Dynamic Mattress deployed its assets so as to generate revenue was not matched by a similarly high profit margin. So we might think that its profit margin was low because, let's say, costs of production were not very much below the revenues per unit. An opportunity for improvement going forward might be for Dynamic Mattress to try to identify ways in which it can reduce its production costs so as to boost its profit margin. The final component explanation for the return on equity of 17% is Dynamic Mattress's debt burden of 0.92. As noted a bit earlier, a 0.92 debt burden essentially says that interest expense does not reduce the return on equity very much. And a small debt burden is consistent with a low amount of debt financing or a high equity financing ratio. So there's a trade-off in terms of boosting return on equity associated with using more debt. Using more debt increases the leverage multiplier, but using more debt will also create a debt burden that is a smaller fraction and therefore results in more of a reduction in return on equity. So as a first step in the financial planning process, the firm typically looks at its historical financial performance and its current financial position. It might use DuPont analysis to identify reasons why its return on equity is high or low and opportunities for improvement. But in general, what the firm wants to do is to think about what's feasible in terms of financial results given its history and its current financial position. This kind of analysis gives the firm an understanding of how it has been able to perform historically, and it gives it a sense of what might be feasible in the future. The second step in the financial planning process is for the firm to define its debt policy. We spent a lot of time in earlier parts of the course on what determines the optimal capital structure of the firm, or what determines the firm's optimal or target equity and debt financing ratios. We won't review that material here, but let's just say, for purposes of developing an example of the process of long-range financial planning, that the firm in question, in this case we'll use Dynamic Mattress, has identified an optimal or target equity financing ratio of 0.4. In addition to identifying its overall, or we might even say long-run, long-range optimal capital structure, the firm needs to identify its target current ratio. The current ratio can be considered the firm's debt policy with respect to short-term financial viability. In our example, let's say that Dynamic Mattress has established a current ratio of 2, which means that they want $2 in current assets for every $1 in current liabilities. Step 3 in the financial planning process is to determine the asset requirements of the firm going forward. Taking this step requires a prior financial decision, which is, what is the financial planning horizon of the firm? In my discussions with chief financial officers over the years, I've learned that firms have a wide range of planning horizons. The range actually that I've heard runs from about 30 days to up to 30 years. But the most common financial planning horizons are, or seem to be, 3 years and 5 years. In the example we'll develop, let's say the firm has a 5-year planning horizon. And let's say the firm has a business strategy which requires it over the next 5 years to add $616 million in fixed assets, that is, plant and equipment. Over the next 5 years, the firm expects to depreciate its assets by an amount of $182 million. This aggregate depreciation expense over the next 5 years represents or reflects an asset value that will no longer need to be financed. Finally, over the next 5 years, let's say the firm has a strategy that requires that it add $650 million in cash and other working capital, which might be inventories or kind of other current assets. If we sum these three components, we get an additional almost $1.5 billion in capital assets that the firm thinks it needs to support its strategy over the next 5 years. The fourth step in the financial planning process is for the firm to evaluate options to finance the additional assets that it has just identified. In the example that we'll go through, the firm has decided that it needs additional equity in the amount of about $344 million that it hopes to generate through retained earnings. It might also think about additional stock sales as another source of additional equity. And the firm expects to add additional debt to its balance sheet in the form of $448 million in long-term debt and $353 million in short-term debt. Now let's see how we go from the firm's current balance sheet to its new balance sheet in 5 years by accommodating the additional assets that are required and these additional financing options. We'll continue to use Dynamic Mattress as our example company. The heart of the financial planning process is the development of a projected or pro forma balance sheet. Has a current balance sheet at the end of 2009, which is described in column B. We've already done a financial analysis of this balance sheet and the associated income statement for 2009. Over here in column H, we're going to put the additional assets and financing options that are necessary to support the strategic plan of Dynamic Mattress over the next 5 years. If we combine the additional assets and liabilities and equities listed here in column H with the current balance sheet account numbers in column B, we'll be able to develop the pro forma or projected balance sheet 5 years hence at the end of 2014. So let's go back and look at the current balance sheet and focus on the assets. We currently have $325 million in total current assets. The plan calls for an additional $650 million in current assets for a total of $975 million in current assets at the end of 2014. Now let's look at fixed assets. We start with a net fixed assets of $250 million. Over the next 5 years, the plan calls for us to acquire an additional $616 million in plant, property, and equipment, to depreciate off $102 million for an incremental net fixed assets of $434 million. And if we add that to our current net fixed assets of $250 million, we arrive at the target net fixed assets at the end of 2014 of $684 million. So looking at total assets, we currently have $575 million in total assets. The plan calls for us to effectively triple our total asset amount so that by 2014 we'll have $1.6 billion in total assets. So these numbers describe our asset requirements in 2014 in order to achieve our strategic plan. Note that we have to grow our total assets from $575 million to $1.66 billion in 5 years. How are we going to finance the acquisition of all these additional assets? Let's look at our financing sources as described in the liabilities and shareholders' equity portion of the balance sheet. In 2009, we have $135 million in current liabilities, $90 million in long-term debt, and $350 million in shareholders' equity, giving us a total financing value of $575 million, which of course matches our total assets of $575 million. Now there are several ways that we might be able to go from $575 million in total financing now to $1.66 billion in total financing in 5 years. But we must adhere to our target financial structure. That is, we want to be consistent with our debt policy. Recall that this debt policy was developed in step 2 of the financial planning process, wherein we established our target equity financing ratio and our target current ratio. Specifically, we established a target equity financing ratio of 0.4, which means that we want to finance 40% of our total assets with equity. So we can go down to this cell which shows shareholders' equity in 2014, and we want this number to be 40% of total assets. I've already calculated it to be $664 million, and you can see that all I did was simply to take the total asset target and multiply by 0.4 to arrive at our target shareholders' equity in our 5-year planning horizon. So we've developed one of the components of our financial structure for the year 2014. The second one I want to develop is our target for total current liabilities. Our debt policy says that we are shooting for a current ratio of 2. That means that current assets are to be 2 times current liabilities. Now, since we've established that we need $975 million in current assets, we can calculate the appropriate amount of current liabilities simply by multiplying the current asset target by 0.5. And that's what I've done here. to arrive at the target total current liabilities of $488 million. The last piece in our financing puzzle is the amount of long-term debt in our financial structure. To determine this number, we need to calculate total assets minus current liabilities minus shareholders' equity to give us the amount of assets that have to be financed by long-term debt. That is to say, we need to come up with a number, really a plug number, that makes the balance sheet actually balance. So we have to finance a total of $1.66 billion in assets, and we've already determined that we're going to use $664 million in shareholders' equity to do so, and $488 million in current liabilities to do so. So we need $508 million in long-term debt to round out our financing amount, or our total financing requirement. Now let's talk about why it's okay to use this process, that is to come up with a plug number for long-term debt. To think about the appropriateness of this procedure, you need to go back to the requirements for long-term financial viability. Recall that throughout this course, we've argued that the key to long-term financial viability is the ability to grow equity. We noted that if a firm can grow equity, then it can raise debt on good terms and at good rates. And if it can grow equity and raise debt, it can acquire the assets it needs to achieve its strategic plan. So the beginning in that series of if statements is if the firm can grow equity. The financial plan we've been considering says that if we can generate or acquire $664 million in equity, according to our determination of optimal capital structure, we should be able to generate $508 million in long-term debt and $488 million in short-term debt or current liabilities. So we have developed a plan to finance our $1.66 billion in assets in 2014 with 40% equity financing and 60% debt financing, where the debt financing is a mix of long-term debt and current liabilities. So the next question is whether this plan is feasible. The feasibility of this financial plan depends on the feasibility of growing equity from $350 million in 2009 to $664 million in 2014. Because we know that if we can get this much equity, then we can get these amounts of debt on good terms, and thereby we're able to support our target amount of assets that we need for our strategy to work. So the feasibility test is really a test of our ability to grow equity. So what we need to do next is to determine the implicit growth rate in equity that is necessary to go from $350 million to $664 million in 5 years. And then to assess whether we think it's feasible to achieve that rate. The required return on equity calculation is actually simply a calculation of an internal rate of return. The firm is effectively going to invest $350 million in equity in 2009, and it wants to be able to have that equity grow to $664 million in 2014. To calculate the required return on equity, I'm going to use the internal rate of return, or IRR, function. And what I'm going to do is to highlight the cells for years 2009 through 2014, or for years 0 through 5. The result we get is a required return on equity of 14%. What this result tells us is that for Dynamic Mattress to achieve its long-range financial plan, and therefore its business plan and its strategy, it needs to achieve a compound rate of growth in equity of 14% per year over the next 5 years. So what Dynamic Mattress needs to do is to assess the feasibility of achieving a growth in equity of 14% per year. It can make this assessment by considering its historical ability to grow equity. So let's scoot over to the DuPont analysis. We can see that in 2009, Dynamic Mattress earned a 17% return on equity. So the required growth in the financial plan is actually below the rate that the company was able to earn in the most recent year. Now, as long as 2009 was not an unusually good year, Dynamic Mattress might conclude that the financial plan that it's developed is indeed feasible. Before moving on, it's useful to consider what Dynamic Mattress might have done if it had arrived at, let's say, a required return on equity that was higher than its historical return on equity. So let's just say, for discussion purposes, that our financial plan analysis came up with a required return on equity or required growth rate in equity of 20%. And let's say that that rate of growth is higher than the rate of growth that the company has been able to earn historically. In this situation, the company would need to think about whether it's possible to do better in terms of return on equity than it has done historically. It could use the results of the DuPont analysis for this consideration. And in particular, what the company might do would be to look at the components of return on equity and assess whether it would be possible to do better on one or more of the component ratios. In particular, the company might want to assess whether it would be possible to improve its profit margin through cost-cutting regimes or other innovations, or to improve its asset turnover through efficiency programs. Improvements in these two components of the DuPont analysis, that is the operating components or operating results components, improvements in these two components of the DuPont analysis, that is the operating components, are good ways to think about improving return on equity. When firms develop strategic financial plans that look to be infeasible, that is, that look to require higher rates of growth in equity than have been achieved historically. Firms are faced with a choice between two options for modifying the strategic financial plan. The first option is to reduce plans for asset acquisition, that is to cut the rate of growth in assets over the 5-year period. The second choice is to alter the debt policy, that is to be willing to take on additional debt or to move to a lower equity financing ratio. Now, of these two options, it should be clear to you by now, based on what you've learned in this course, that the option of moving toward more debt financing imposes incremental financial risk on the firm and may not, other things being equal, be the way that the firm would want to derive or develop a feasible strategic financial plan. The other approach of cutting back asset acquisition rates also has risks, specifically risks of missing business opportunities. And so achieving a long-range financial plan that is both feasible and risk minimizing does amount to kind of a balancing of the achievement of a target or a cost minimizing capital structure and taking advantage of strategic opportunities that present themselves and may not be there in the future. The final step in the long-range financial planning process is to integrate the information that we've just developed into the management control structure of the firm. Note that the required return on equity from the long-range financial plan informs the determination of the R sub E, or the required return on equity, that's used in the weighted average cost of capital calculation. Specifically, if the firm understands that it needs to achieve a growth rate in equity of 14% to make its long-range financial plan work and to achieve its strategic objectives, it may want to use 14% as its required return on equity in the weighted average cost of capital calculation. Then, proposed projects or business opportunities are evaluated at the weighted average cost of capital that reflects the required growth in equity, let's say of 14%, with appropriate risk adjustment. If the project can be expected to generate a positive net present value, then the project generates enough cash to cover its operating costs, cover its debt service, and grow equity at a rate that is sufficient to make the financial plan work. Yes, indeed. Go Blue.